understanding alternative investments, private equity, private credit, hedge funds, and more. If you've been investing for years using the traditional 60-40 portfolio, 60% stocks, 40% bonds, you might be wondering, is this really enough anymore? Market volatility is higher than ever. Bond yields haven't kept up with inflation, and stocks, they're unpredictable, especially when interest rates and geopolitical risks are in constant flux. Meanwhile, the largest and most sophisticated investors in the world, think Yale, Harvard, major pension funds, are allocating 40, even 60% of their portfolios to something entirely different, alternative investments. So the question is, what do they know that most individual investors don't? And more importantly, how can you use the same principles to protect and grow your wealth? Hi, I'm Josh Bliss, founder of Gateway Capital Management, now proudly part of Balboa Wealth Partners. We help affluent families and individuals approaching retirement build smarter, more tax-efficient portfolios that are designed to last. And one of the most important conversations I've been having with clients lately is about alternative investments, what they are, how they work, and how they can fit into a diversified, long-term plan. Because this isn't about chasing performance, it's about designing a portfolio that gives you more stability, more income, and less reliance on the public markets. If you've ever heard terms like private equity, private credit, or hedge funds, but weren't quite sure if they were relevant to you, this video will connect the dots. And if you find this helpful, go ahead and like the video, subscribe to the channel, and leave a comment below with any questions you want me to cover in a future episode. Let's get into it. Part 1. What are alternative investments? Let's start with a simple question. What exactly are alternative investments? When most people think about investing, they think of the basics: stocks, bonds, mutual funds, maybe some cash in CDs or in a savings account. That's the traditional approach. And for many years, it was considered the gold standard, especially the 60-40 portfolio model. 60% equities for growth and 40% bonds for stability. But over the last 2 decades, the financial landscape has shifted. Interest rates have remained historically low. Bond returns have been modest at best, and stock market volatility has increased. That's why more investors, especially institutions and high net worth individuals, are looking beyond the traditional toolkit and into the world of alternatives. So what does that include? Alternative investments are broadly defined as anything outside of publicly traded stocks, bonds, and cash. That can include private equity, investing in private held companies; private credit, lending to businesses outside the traditional banking system; hedge funds, using advanced strategies to manage risk and return; real assets, like real estate, infrastructure, or natural resources; venture capital, early stage, high growth, private company investing. These investments often come with longer time horizons and less liquidity, but in exchange, they offer something incredibly valuable: diversification that's not directly tied to the ups and downs of the stock market. In other words, alternatives can give your portfolio access to different sources of return and help reduce your overall volatility. They may not replace your traditional holdings, but they can complement them, especially when your goals shift from growing wealth to protecting it and generating income. For investors looking for smarter ways to build a resilient retirement plan, this is where alternatives start to play a meaningful role. Part 2. Why institutions rely on alternatives. Now, if you're wondering whether alternatives are just a new trend or maybe too complex for individual investors, consider this. Some of the most successful disciplined investors in the world have been using alternative investments for decades. Take the Yale Endowment Fund, for example. Led by the late David Swensen, Yale pioneered the shift away from traditional 60-40 investing. Today, over half of their portfolio is allocated to alternative investments like private equity, hedge funds, and real assets. Why? Because they recognize something that's just as relevant for retirees as it is for universities. Public markets are efficient. Private markets offer a different edge. And Yale isn't alone. Harvard, Stanford, and other Ivy League endowments use similar strategies. CalPERS, the California Public Employees Retirement System, has increased its allocation to private credit and private equity in recent years to enhance returns and manage risk. Major pension plans across the U.S. are doing the same. Here's what all of them have in common. They're looking for uncorrelated returns, assets that don't move in the same direction as S&P 500. Why is that important? Because when public markets drop 15, 20% or more in a given year, The goal isn't to predict the market, it's to hold investments that aren't tied to it. By blending in alternatives, these institutions can smooth out volatility, generate consistent income, and reduce the emotional roller coaster that comes with market timing. And while these institutions are managing billions or even hundreds of billions, the principles they use apply to individual investors too. If you're in retirement or already retired, your biggest concern probably isn't beating the market, it's making sure your wealth is protected, your income is reliable, and your portfolio can weather whatever comes next. And that's exactly why these institutions lean on alternatives, and why more high net worth individuals are starting to do the same. Part 3. Benefits of alternative investments. So what exactly do alternatives bring to the table? Here are 3 major benefits. Number 1, diversification. Alternatives often respond differently to market cycles, helping reduce correlation and smooth volatility. Number 2, enhanced return potential. In private markets, investors can access opportunities not available to the general public, sometimes with higher return potential. Number 3, downside protection. Certain strategies, like long-short hedge funds or private credit, are designed to provide stability even during market stress. This is why many investors are now moving away from the old 60-40 stock-bond model and adopting a core plus alternatives approach. Part 4, understanding the key strategies. Let's quickly define a few of the most common alternative strategies. Private equity. This means investing in privately held companies, often before they go public or get acquired. There are over 100,000 private companies generating $100 million or more in annual revenue. Most investors never touch this space, but it holds enormous opportunity. Private credit. This involves lending directly to businesses outside of the traditional banking system. In return, investors may earn yields in the 8 to 12% range, often secured by real collateral. It's become increasingly popular as banks have pulled back on lending. Long-short hedge funds. These strategies invest in both rising and falling markets, known as going long and going short. The goal is to capture returns while limiting downside, especially in volatile markets. Each of these has a specific role to play, and none of them are one-size-fits-all. Part 5. Who are alternatives designed for? Let's be clear, alternatives aren't for everyone. They typically require a longer investment horizon, higher minimums, and a willingness to accept lower liquidity. But if you're a retiree, business owner, or high net worth investor looking for better diversification, more consistent income, or protection from public market swings, alternatives may deserve a seat at the table. It's not about chasing the next big thing, it's about building a more resilient, tax-efficient, long-term strategy. Part 6, should you explore alternatives? If this is something you've been curious about, now is the right time to explore it. At Gateway Capital Management, we help clients access institutional quality alternative investments within a fiduciary, transparent framework. That means no product sales, no commission-driven strategies, just objective advice based on your financial goals. You don't have to guess, and you don't have to go at it alone. If you're nearing retirement and want to know if alternatives could strengthen your plan, let's talk. Click the link in the description below to book a free consultation. I'll walk you through what's available, what makes sense based on your situation, and how we help clients incorporate these investments thoughtfully and strategically. Thanks for watching, and remember, true diversification isn't just about owning more investments, it's about owning the right ones, for the right reasons, with the right plan.